I'm going to talk about some funds we manage, but I'm not trying to sell you any of them this morning. In terms of our management team, three key individuals behind Sustainable Technology Investors. The chairman is Gordon Power, who's been working in the VC and private equity industry since the early 80s. Started a lot of early VCT funds back in the 90s. Founded and managed program private equity for a number of years, exited that in 2004, and has come back into the private equity space through Sustainable Technology Investors and one or two other vehicles. I've been at it in Cleantech for about 20 years now. Started in graduate school 20 years ago this autumn, but then, like one or two other people in the room, I went from science and trade to the financial services industry. Spent time at PwC and Citigroup, among others. And then the original source of finance behind our business is Stephen Lansdown, founder of Hargreaves Lansdown. The Guernsey connection I will come on to shortly, but Steve is a big believer in this sector and has put his own capital behind it to help fund a number of our investments. So I'm going to do a quick canter through three of the funds. We're looking after our Guernsey vehicle, our EIS fund, and our new energy efficiency fund funded by the Green Investment Bank. So firstly, our Guernsey fund. This is our original family office vehicle that Stephen Gordon put together in 2009. One of the ways of thinking about it is a fund manager strategy. We back 6 asset development platforms, 2 in renewables, 2 in energy efficiency, 1 in anaerobic digestion, and 1 in the renewables fund. And the idea is to seed those management teams, those GPs in their early days of working capital, and then go on to raise third-party money through institutions, family office, or retail source of capital. And 3 examples of those raises we've done this year from funds that we see here. The first one is the UK Energy Efficiency Investments Fund, which is now seeded, cornerstone with 50 million investment from the Investment Bank, which closed in September. Just announced our first deal a couple of weeks ago. We'll come on to that in a little bit more detail in a minute. Tamar Energy, which is our anaerobic digestion platform. We did the original Series A venture out there back in 2010 with the seed funding there. That's gone on to raise 97 million to develop biogas plants in the UK in 2012. And then the third example is C Capital, which is our Spanish family office backed fund. Focuses on renewables and mainly wind, solar and biomass across the EU. We have also done some VC investing, although I have to say that's the minority of the capital we've put to work. So we've got 3 earlier stage tech investments in the portfolio, Propeller and water efficiency, Cereslow in renewable building materials, and Arvia, which is industrial energy efficiency and waste treatment. This fund sits in Guernsey, as does Steve Lansdown himself. He moved there getting on for 3 years ago now, and we manage that fund out of Guernsey. The second one I'll talk about very briefly is our EIS fund, which we're raising at the moment. But this is an opportunity for EIS investors in the UK to access some of the deal flow that's been created by the family office platform. We're not going into things like solar and wind. We're looking at AD, hydro and biomass as our 3 main renewable and clean tech infrastructure technologies. We will have a side market to that fund doing early stage sustainable venture investments as well. But basically the fundamental part of the EIS strategy is to generate cash yielding assets that will give EIS investors their exit returns in 3 to 5 years. And then the final one, 3, is the UK Energy Efficiency Investments Fund. This has come about through a strategic relationship with Sustainable Development Capital, headed by Jonathan Maxwell, who I'm sure many of you know. We invested from the Guernsey fund into Jonathan's business about 18 months ago, really as a growth capital investment. The business was revenue generating, but looking for further expansion capital for Jonathan to grow that business. And then having made that investment this year, we bid in the Green Investment Bank energy efficiency tendering process. We're successful with that, securing a £50 million cornerstone investment from the Green Investment Bank in September. The strategy of this fund is absolutely infrastructure. This is not venture or growth, this is building real kit. So in terms of our target sectors, this is building retrofits, CHP, district heating, industrial energy efficiency and renewable heat technologies. Essentially, we're going into a host site, funding the energy efficiency kit on that host site, and the savings from those energy efficiency assets pay a financial return back to the fund for a period, after which the assets revert to the host. So it's win-win all round. We set up investment recently with Gordon Harris sharing, and then a couple of weeks ago we announced our first deal, which is to put energy efficiency retrofit equipment into Kingspan up in North Wales to save energy at their manufacturing plant. Very simple set of interventions. This is lighting, air blowers, air compressors, various speed motors and equipment like that. We are at the same time working on a second close for this fund, talking to a number of institutional investors, looking hopefully to bring that up to about 100 million, probably something like Easter next year on the time scale for that second close. And I think a lot of institutions, they get energy efficiency as an asset class. Perhaps there'll be one or two reservations about some of the political and regulatory risks associated with renewables, energy efficiency being purely commercial at arm's length, and actually a very simple asset class to understand. I think it's getting a lot of interest now, and we can offer investors a very solid infrastructure equity return.
Interesting what you're doing. A company called AHS did that nearly 30 years ago. Another company called MSTAR did it nearly 30 years ago. AHS was Associated Heat Services, Lord Ezra headed it up, MSTAR was Shell. I think PP Energy had one doing the same thing. What's different now, a generation on, than was then?
I think what you've got at the moment is a lot of infrastructure owners and corporates who have balance sheet constraints. So some of the deal flows are coming to us through old leveraged buyout deals, where the balance sheet, you say, is interesting, but there's an opco sitting at the bottom of it which is perfectly solid and cash generative. And there isn't, in many cases, a B through cash to go and fund energy efficiency assets. And yet, there's a perfectly good credit story down to the opco level, and we can fund those. You've got other constraints on capital budget. Look at public sector capital budgets at the moment. They're very constrained. And again, from our credit story, going into local authorities, universities, hospitals, that's a very strong story that's very easy to build a finance case around. And I think there's a number of sources of deal flow that we can execute the strategy through. Energy efficiency, at the end of the day, is quite a simple strategy. It's all about counterparty credit. Who is the host? Who is the technology vendor? Who is the EPC? You get those right, actually you can build a nice yielding asset which is refinanceable. We can, if we do a good job here, we can play real estate yield compression type games that the private equity industry has been familiar with for decades. It's actually, we're not trying to take lots of tech risk, we're not trying to take lots of startup risk, SME type risk. This is just about executing well on a very straightforward infrastructure strategy, and that's what we think we can deliver.
But with respect, that was the model they pursued, and they're no longer in that business. So what's different?
Well, I'm not sure what's particularly different since then, but we're getting deals done now with that strategy. We know the financial markets are looking out for yielding assets. If I go and pitch an institutional fund at the moment, a 10-year closed-end fund in venture growth, and Francis touched on this earlier, people really want that right now. I've talked a lot about these, no they don't. We can offer yield. In many cases, it's index-linked yield. If I go and do a local authority street lighting retrofit deal, that could be a long-dated piece of paper with indexation. Now, 15, 20 years of municipal credit, indexation, where can you buy that? And think of the institutional investors, the pension funds, the SIP market. Think of their interest in that piece of paper. That's why we're going to get this work.
Just one question over here, and I think we'll move on to the next. Anna speaking.
It's just the UK aspects, and I can understand that from the infrastructure point of view. But will any of the projects you invested in, will they have any international element? Will any of the models that could be rolled out overseas, or are you just studying it?
Absolutely no reason why not, but right now the focus is absolutely on the UK. With Green Investment Bank Fund, the mandate is to deploy that capital into the UK. It's very reputable elsewhere. but that's not a priority for the first, probably, the next 12 to 18 months, which is looking at executing very well in the UK. After that, I'm sure we will be looking at the model.